January 16th here with Mobile Mailbox Money and Eckman Wealth Management. I'm here with Daryl Eckman and Kris Venezia. Fellas, Happy New Year. We haven't caught up since last quarter.
Yep.
So it's great to sit down, see what's kind of going on, maybe get a take on what's currently developing here in 2025.
Sure.
Happy to have you here today, fellas. I know that we had a couple case-specific topics to talk about that are kind of frequent questions that you guys get on a regular basis, geared towards like the Fed, interest rates, inflation. So those are a couple topics that I figured we could talk about here today with Eckman Wealth Management. So appreciate having you here today, fellas. Maybe Kris, if you could just touch lightly on first quarter here in 2025 and maybe what you guys see developing given the current financial market, what's going on in the news and things of that nature. Happy to have you here today.
Yeah, thanks for having Eckman here. It's always great to talk and come on. I think, there's so much happening right now. It's information overload just with, a new administration coming in. There's just a flood of economic data, and we just started what's considered earnings season. So large US companies reporting their earnings, giving us a snapshot, and a lot of attention, particularly for a lot of names, big US companies, given that we're talking about the quarter that ended 2024, which is a pretty big quarter for a lot of, especially consumer-facing companies. We're a consumer-driven economy here in the US, so you're getting a sense of what were the holidays like? Were people spending through the holidays? Is there an increase? So a lot of information coming in. I think the general summary I'd say to put it on is, things in the US continue to be, in some ways, almost surprisingly strong. People still spending a lot of money. The holiday spending trends we're seeing were very strong. And the first batch of corporate earnings we've gotten, which have been from large banks, have been very healthy. The concern that comes out of all of that is, do we get to a point where we see inflation overheating, right? People spending a lot of money, right? The old too much money chasing too few goods. And what does that do on the inflation side? So a lot of positives, I think, on the U.S. economic side as we wait to see what this new administration does, but certainly some potholes potentially lingering as we see what the impact is of still a U.S. economy that's been trucking along.
Daryl, what's kind of your take on that? I think a lot of people were speculative on like the consumer aspect. You see a lot in the news last year, potentially of, some diminishing activity, but in the analytics, provided, it's actually a little stronger than what originally anticipated. Kind of what's your take on that?
Well, as Kris was saying, he's mentioning some of the big things that are going on out there, but there's a number of things that are underlying a lot. We spend a lot of time on the details, things that don't make the news. Lately, the fires in California have been gobbling up most of the mainstream news, and even I would say the business channels.
Absolutely.
What we have to do is we've got to spend time on more, I wouldn't even call them detailed things, but things that just don't make the news. We spend a lot of time on how things line up to history too. And then of course we've got the new administration that's now picking the cabinet, and already we're starting to see some controversial things happening there. Now, one of the things that I said last time when I was here, it doesn't matter who's in office. Absolutely does. But the markets do well under both blue and red administration. That's right. So we keep our powder dry from there. But so, as far as prognostications go, it's a little early to see what's setting up for 25. I'll throw it back to Kris because he spends more time on a lot of the current stuff.
Yeah, I think that was an important point, not to cut you off there, Kris, but you got to pivot with, any administration at any given time. It's important to be nimble and diversified out in the market.
And if I can interrupt you, just keep your head, because we get so embroiled with, our man that's in or our the administration, or the cabinet,
Absolutely,
all the way down to local government.
Absolutely.
There's quite a bit happening right here in our own backyard in Scottsdale. Big changes going on. So it's all the way through.
So
Yeah.
go ahead, Kris.
Yeah, and I would just kind of stick in on keeping your head. When Biden was coming in, there was a lot of expectations of what would happen, and certainly over those four things, only a portion of that agenda came to fruition. And I think that's the big thing is people hear a lot of things. They say this is definitely going to happen. And I'm sure there's people in the Trump team that want to do a lot of things, but I think what happens on the campaign trail versus what actually happens when we get into the White House and when a new Congress comes in, those are two separate things. So the biggest thing really for us is, paying attention and staying active, but it's a lot of patience because there's a lot of things in these campaign books, both with Democrats and Republicans, where they're talking about making changes. Those changes don't actually happen. So it's a lot of paying attention, being on your toes, but not being so proactive that you end up hurting yourself by planning for a scenario that never actually occurs.
Yeah, that's almost like the shiny object syndrome. I call it, you don't want to get blinded by what's going on at any given time. You got to be cognizant of the circumstances available, and it's tough when the majority of what's on the news, is one specific subject or a state of emergency we're seeing in California. It's hard to see through a lot of that stuff and know where to get your information at. At the end of the day, there's other things going on in the market, as this tragedy is taking place. It's, definitely unfortunate of the situation, but we got to be nimble and pivot at any given time, as well as make sure we're getting the right analysis from the market that's current and up to date and not being skewed, by other, reports and things of that nature. So I know recently the Fed came out last quarter, however long ago, a couple weeks ago, about a month ago, and increased interest rates in mortgages, but also, the bond rate. It was in speculation. Maybe you guys could just touch lightly on how interest rates may affect this year, or, people are kind of waiting to see possibly what's going on. Some people are wanting them to reduce, trying to make predictions. What's your take on that?
I'll jump in first, and it has been just a seesaw, back and forth and back and forth.
How to navigate?
The Fed themselves, I don't think really have much clarity right now. The numbers are up this week, down this week. The leading indicators, the current indicators, it's been all over the board. Some of the things that we felt really fairly strongly would happen in 24 and even back in 23 just did not happen for me particularly. Kris was a little bit more right than I, and Clint and some of the other guys were just a little bit more right, but we were all kind of scratching our head. We didn't have real conviction on what was happening. So that kind of goes back to what we were just saying. We have to make sure that we stay on top of things and not get too far out and upset the portfolios.
Absolutely. What's your take?
Yeah, I think that there's this dynamic, I think, right now in a couple areas, and rates are one of them, where there's sort of the Wall Street versus the Main Street. So, Wall Street's dealing with, what Wall Street deals with, but then Main Street and everyday folks are feeling something entirely different. So the Federal Reserve started a rate cutting cycle, which impacts short-term rates. And what that means in normal speak is that applies to rates on what you get maybe on a savings account. So a lot of people who have things like high-yield savings accounts, they're seeing that interest rate that they're getting for those deposits go down. Now, longer end rates, things like mortgages, things like your car loans, things like if you're getting a home equity loan, that stuff is dictated by what we call longer end rates. So like lending the government money for 10 or 30 years. Those rates have actually risen and stayed higher. That has less to do with the Federal Reserve and more to do with there's an expectation that, the U.S. spending is a little bit out of control right now. And so people are factoring in, well, if the U.S. government is going to be spending and running a deficit, well, then they're going to have to pay a higher interest rate for their debt. And that pushes up rates on the consumer side. So I think the general framework is on why, your mortgage rate is 7+ right now and why a car loan is just so ridiculous for a lot of people right now is because there's this expectation of the U.S. is running a deficit. It's unclear whether or not that's gonna shrink over the next 10 or 15 years. And a lot of people that speculate on Wall Street believe the U.S. is not doing a good enough job on the fiscal side, and that's what's pushing rates up. So, our expectation certainly over the next 3 years to 4 years is that you get some relief on rates, But I would say when I talk to people and they say, where's the 2 or 3 or 4% 30-year mortgage rate coming? It's hard for me to picture a scenario where we get back to a 3% 30-year in the near term. I think that time came and went.
Yeah, that may never happen again. A 3% mortgage. It'd be hard. There'd be some real hurt out in the market for them have to put a 3% mortgage. That came and gone, like you said, at the end of the day. And I really see, what you're saying is kind of contributing to our business. We focus on low-cost housing, and we've seen an increase in demand for low-cost housing, kind of translating to the challenges I think the average consumer, has been having a little bit. But that kind of goes hand in hand at the end of the day with what we see, mutually moving forward here in 2025. There's a lot to take into account, and it's important to align with the correct information and knowledgeable individuals in the industry to be able to get the most up-to-date information. As 2025 progresses, what do you think are some potential outcomes given the current market? There's a lot going on. We got wildfires, we got fluctuating interest rates. The Fed doesn't really kind of know how to right the ship a little bit. There's a Middle East, there's a war in Ukraine going on. There's a lot going on. What do you kind of see maybe some potential outcomes, moving forward here in 2025? You talked about a 3-year kind of program. Maybe you can just touch on that lightly.
Chris, why don't you take that?
Yeah, so, obviously, I think you kind of hit on it in there in terms of what those outcomes are going to be from 2025. The biggest challenge we have right now is on the geopolitical side. I think we're in an environment right now where you mentioned the Middle East, Russia, Ukraine, China, Taiwan. It's one of those environments where there is that possibility that you wake up one day and there's some interaction with China, Taiwan that has a major impact on markets, or if things escalate in the Middle East, it has a major impact on oil prices, which of course would bleed into markets. So those risks that are much harder to calculate are higher, and that's something we certainly have to consider when we're figuring out what assets belong in portfolios. All of that said, even in an environment where those geopolitical risks are higher, interest rate risks are higher, there is a belief out there, especially on Wall Street, that given some of the stuff that's happening on the tech side, think artificial intelligence, that we are setting up for a pretty strong year, at least when it comes to U.S. companies. And the general framework when it comes to stocks, and you got to pull up all these charts that verify this. If companies are making more profits, there's a pretty good possibility that there's companies worth more money and the stock price is going up. And there's this belief that things like AI and potential things like tax cuts that are discussed in DC, that those things help to beef up profits of a lot of big U.S. companies. And that's a positive when it comes to U.S. stocks. So I'd say generally Wall Street is pretty optimistic. You see it in retail side. People on the Robinhood and their Vanguard are pretty optimistic on the stock side. The big caveat there is we have those bigger geopolitical risks that are much harder to dictate. And if anything happens there, the pain of that will come pretty swift.
That was a great answer.
Yeah. You mentioned AI a couple times. I have a tendency to fixate a little bit more on AI. It's out there. It's coming fast. It's coming faster than what we think.
Absolutely.
That's my kind of my area, and we discuss this all the time. We have to keep an eye on the things that Kris is talking about, but AI is the 800-pound gorilla that is marching its way to, this decade, next decade for certain. Trying to figure out what areas will be affected first. A lot of things have really been a surprise. For example, a lot of people thought that the white-collar worker was going to be last to be affected by AI. Well, it's the opposite. The white-collar worker is being taken out pretty quickly. They're being replaced by other things, but it still is going to be a difficult thing to ascertain. So I read a lot of books about, what prognostications, that some of these people are really smart people that are trying to figure out. I don't want to get too far into this, but this certainly is a teaser. Maybe for the next time we do one of these market updates, we can talk a little bit further about, longer term effects of artificial intelligence in pretty much all aspects, from farming to medical to, we see it every day. And I'll put a small commercial in for Eckman Wealth. We really do try to stay really focused on hands-on. So we pick up the phone.
Not a lot of people answer the phone nowadays.
Right, right. We don't let it ring. We pick up the phone. Somebody's going to be, and it's going to be actually a human being that's going to be talking to you. So there it is.
Yeah, a lot of new tech, a lot of new banking, a lot of new tokenization. There's a lot of conversation being thrown around, especially with like crypto. You got quantum computing coming out. These are like new frontier things that are developing out in the market. It's kind of interesting to see. It's a great time to be alive, the saying goes, to be on the cusp of all of this new engineering, new capabilities, new business ventures. So, happy to have Eckman Wealth Management here today, kind of give individuals watching here a little bit of understanding of what's going on, maybe what analysis maybe we're driving, and things of that nature. So again, appreciate having you here today, fellas. Alden Guajardo with Silvercrest Opportunity Fund and Mobile Mailbox Money. View our previous vlogs and podcasts. Eckman was on the podcast a little while ago. I think it was about last quarter. So we'll have them on again to provide you the most up-to-date information on what's going on out in the market. So happy to have you here today, fellas. Bam, bam, bam.